not winning 90% of your new business because you have some sort of incredible value.
I'm going to take a bit of a different angle.
We got a budget this big. I'm going to give it to you because you have a really killer plan.
You give a Red Bull to a turtle, what do you expect?
I think that's a dead turtle.
So let's move on to...
Rick.
Cheers.
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 Does your current premium finance company lock you into long-term agreements? That's because they don't want you talking to us. At IFS, we win your business the good old-fashioned way, with customer service. I know you don't always have to use a premium finance company, but when you do, you should use IFS. Cheers.
Hi there, and welcome to another episode of the Digital Insurance Pint Podcast. As always, I'm your host, Tom Reed, and I'm joined by my colleagues, Adam Mitchell, CEO of Mitch Insurance.
Hello.
Steve Earle, CEO of Cheap Insurance.
Good day.
And Jeff Roy, CEO of Excalibur Insurance.
Welcome, Pinters.
A quick shout out to IFS Premium Finance, our premier sponsor. Thanks, guys, for all you do to support us. Much appreciated. So today we're going to put our big boy boots on and talk about what brokers want, and specifically talking about CPCs, or contingent profit sharing commissions. So for the 4 people in the industry that don't know what a CPC is, it's a profit sharing arrangement between carriers and brokers that rewards brokers providing the carrier with business that generates an underwriting profit. Right? Profit sharing, fairly straightforward. A lot of places have that. The basic premise is that brokers have influence over the underwriting profitability and will or can direct that business to carriers that offer these rewards. Right? 2 main factors typically drive underwriting profitability. You got your risk selection, also known as underwriting, and risk pricing, also known as what actuaries do. Historically, the broker channel has demonstrated an ability to generate lower loss ratios than the direct channel, lending some credence to the notion that brokers provide some sort of frontline underwriting for carriers. So let's talk about CPCs, guys. So let's talk about, first off, like, how much of an incentive is that? Like, what percentage, if your brokerage generates $100 in total revenue on average, because obviously this varies from year to year, on average, what percentage of that $100 in revenue is CPC? Maybe Jeff, I'll get you to start.
I would say generally brokers look at about 10% is kind of, but some of the better ones are probably into the 20% back when the golden age of CPCs. But I think it's diminishing right now. I think CPCs on the curve of diminishing returns.
Yeah, I just did 3% as sort of a good CPC period into an average commission of 14%, and that represents 20%.
So 20 would be the high end, like a very, very good year. What would you say the average would be?
I would say 5 to 10%.
Of premium, 1% is sort of the bad year or the low if you're diversified and sort of scaled. And then 3% is sort of good year. And I think we had COVID bumps that were better than that. I think there's a couple of variables. There's probably a gated decision on where you live in based on what tens of million tap category you've reached. Because we've gotten significantly more stable as we're now, way bigger than we used to be, and we have all the markets. So some markets drift in and out of profitability, but inevitably there's a panel of a bunch of them that are paying.
So I can tell you from the carrier's perspective, having spent time at both Intact and Aviva, now this does go back a little bit, so I'm not sure what's happening, today, but on average, carriers would budget about 2% of premium. So if you figure an average, they're paying an average of, let's say, 16%, that's 1/8, 12.5%. So that 10 to 20 range kind of makes sense, with 10 being more average, let's say.
Sorry, and I was doing 10% of commission. I want to be clear of commission.
Yeah, that's what. Yeah, that's
so
what
you'd asked originally commission. Now we're sticking more to premium. Okay, perfect.
Well, and I'm just saying from a carrier's perspective, it's 2%, but 2% on the 16 they're paying is 1/8, 12.5%. So anyway, in the same ballpark. It's sort of in that 10 on average, maybe higher depending on a year could be good. And I should also point out that loss ratio for most carriers, up until today, is the predominant driver of what CPC check gets cut, but there's also some retention bonuses or growth bonuses, and there's also, as Adam alluded to, some tiering. So if you're on the lower scale dollar-wise with a carrier, you might be in their bronze level, you get different metrics. If you're in their silver or gold tier, whatever those carriers call it, the factors, the ratios will be quite a bit higher for more volume.
Yeah, so smaller brokers, I think a good year, really good year, would be 2% of premium.
Yeah. So
overall.
So again, that's your 12.5 of revenue.
Yeah. 0.5, 0.1, or none. I've seen none.
Yeah. Now I'll also point out when a broker gets a 0 CPC, the carrier is negative. So
No, Tom, no, I'm going to correct you. Sometimes you can have an outstanding loss ratio, but one of the other criteria was off, such as retention. Your retention was 89% and it needs to be 90, even though we made rules of money. You don't qualify to share anymore.
good point. I was assuming you were at 0 because of your loss ratio, but yes, there are some disqualifying factors. So yes, you can be very profitable, miss out on retention or a tiering. You could be under the bronze level in terms of volume and therefore not qualify.
That was the worst. A few years ago, a company raised its rates drastically to recover from the market, was making money hand over fist on the books, but because they raised their rates so drastically, everybody's retention fell below qualifying. And so that was the one we had a problem with, because the spirit of that agreement was put in that if your retention drops to X, was an anti-roll mechanism. It was built so that brokers didn't like skim from one market, put over here, and then next year skim it over here, and be swinging back and forth to play a game. But what it got caught with is that market monkeying with their pricing then meant, oh, great, all profitability slides to company side, zero part to distribution.
Mm-hmm.
Well, yeah, the other thing too is you had a perfect storm of factors, coming off a not great year and then entering COVID with indecision. So, the actuaries made their call, and their call affected brokers for quite a bit of money, right? And, it's one of those things, it's two sides of the axe. You're going to be profit and you're going to grow. But if you don't, how much control do we have growth if the actuaries are priced the product 15 or 20% above market? There's not really much you can do as a broker, right?
Yeah, and it was the spirit of the rule, quote unquote, or contract, was to insulate the insurer from having to pay CPC to a broker who's currently in the middle of moving their book of business. That was the intent, but the technicality was the broker's not moving any business or moving business because it's rate. It's an action that the insurer took, and in order to conserve the business within the brokerage, it had to be moved, because you can't convince consumers to pay 25% more because you're nice and you leave it there. You got to move them around. So it's the actions of the insurer create the retention rule.
Yeah, the retention rule it's in a lot more contracts now. It's becoming more the norm now.
So the interesting thing about CPC is that it is in theory, it's sort of a master class in incentives or psychology, right? It's a mathematical model that is trying to incent brokers to do certain things. Brokers are free agents, right? And carriers get that. You can move your business whenever you so desire. Of course, you will have the expense and risks of doing so, but you could, whenever you wanted to, move that business to wherever you want. So obviously, carriers want to incent brokers to keep their business with them, and that's through the day-to-day stuff of good claim service, good pricing, good underwriting service, all that kind of thing. But then there's to differentiate between carrier A and carrier B, who might do their jobs really, really well. Here's the CPC thing, and we're going to put some incentives in there to make me as your carrier more attractive than that guy as your carrier. But when you get into some edge cases, some of those incentives end up being counterproductive because that edge case wasn't considered when that model was built.
The growth incentives, so those are being introduced in tiers. So grow by X and you hit this tier. Grow by this much, hit this tier. So the tiers are being applied to, you can up yourself even as a small broker into another tier of payment because your growth has been met a certain threshold.
Right. And then essentially the same outcomes from your perspective are more, compensated at a higher rate because you're in that, you're now a silver tier. You get to go into zone 2 with Air Canada instead of, with the back of the bus with the rest of the hoi polloi. So let me ask you guys a couple of questions, right? So one of the first things I worked on, this is not a question, it's more of a statement, but one of the first things I actually worked on when I joined the insurance industry, 30 years ago, was CPC for what was then Wellington Insurance. And Wellington had some fairly complex models that they had built. And a lot of those were built on the theory that brokers had some control over the loss ratio of a carrier, right? Frontline underwriting. And historically, that is absolutely true, right? And the evidence for that is you look at the overall loss ratio of the broker channel and the overall loss ratio of the direct channel. And historically, there has been a 5 to 10 point difference at that highest level. So the only real difference between those two is a broker. With black box underwriting and a lot of AI that's being built into this, the factors that drive loss ratio are getting way more complicated than ever. And I guess simple question first off, can you guys today per market identify what that market's desired client attributes are at any point in time?
Here's the thing. If you can, how long can you expect them to stay there? Because so this is the piece of like trying to guess this and get it right is like such a mug's game, because then there will be a new underwriting manager, a new actuary, a new theory, new data, market trends. Like no doubt they are all going to continuously move and evolve and slide up and down. Right now we like young drivers and now we don't, and now we're going to go 14 and 20 star and then we don't, and that's them responding to the market. The one that bugs me to no end is when you look at moving a book, or somebody wants to skim a book, or they want to grow and they're trying to incentivize, and they say, okay, let me have a look at the experience reports, the broker experience, the loss ratio details of it. So, okay, great, here you go, here's the thing. And I say, okay, I think, what are you going to respond to? Because unless you have the exact same segmentation and the exact same pricing, aside from frequency, what are you going to read off this thing that has any relevance to your pricing model?
The other challenge too is the earned versus written premium part, right? If you send your skim and you send it over, you've got all the risk on the book, but the premium hasn't earned itself out. So that can be devastating. And for new business, if you have one company, if their rates are changing and they lose what they're writing and it changes next year, let's say they give new drivers to Canada 9-star 1 year, and then all of a sudden it's down to a 0 or some other class.
Well, you won't have the same discounting. You won't have the same price banding. You won't have the same reserving practices. So the only thing that's pretty universal in there is the frequency. Here's one of the things that I don't think the industry does well is segmenting frequency, segmenting all kinds of data around age banding. We bundle it all together and say, here is a broker's book. You're like, great. What percentage of that is 20-year-olds and what percentage of that is 50-year-olds? And do you think they might perform differently? Like, and saying that this one isn't good because it doesn't stack up against this one of 60-year-olds. Like, if you haven't appropriately benchmarked, I think you're using pretty asinine data.
So my $64,000 question here is, given black box, AI-driven, complicated, ever-changing pricing and underwriting rules, which, if I just put my hero hat on for a second, are done because the carrier actually wants to make money, and it's very complicated, and this is the way to do it. So that is not going to change. What can brokers do legitimately to influence a positive loss ratio outcome from a carrier's perspective?
On personal lines?
Yes, on personal lines, yes.
I think the only two things you could really do and stay compliant with current regulation is you can avoid liars and fraud, as the industry doesn't currently tolerate that. And we can make sure we're getting the actuaries and underwriters absolute accurate data to rate off of it. So properly rating the things and making sure they get full underwriting review. But beyond that, we don't have any of the pricing around margin. Like that's all somebody else.
Putting my former carrier hat on, I love that answer because I did some work years ago on fraud. We were looking at some of the indicators or attributes that would suggest fraud was present, and something in the order of 10 to 15%, potentially 10 to 15% of every claims dollar is fraud, and that can be just outright never happened fraud, or aggrandizing a claim so that it's more higher severity than it should have been. So if you could take chips out of that fraud bucket, that is absolutely a benefit from a loss ratio perspective. And by the way, it's illegal and shouldn't happen anyway. So, it's also morally a good thing.
Yeah, but Tom, how can the broker smell test that in advance of, Adam's bald. And I think that bald people will say that they had a Sony when they actually had a Sanyo. So he looks like the type that would do that sort of thing. I'm not gonna place him with that market. How do we do that? We can't. We technically can't.
Adam, what were you thinking of when you said that fraud was something you guys could have an impact on?
Yeah, I mean, there's some pretty serious discussions around previous accidents and the output of it. And can you explain away how you have previously used a claim? Is there accident benefits that's this big, or is it a lot of big? And what's the story with it that goes with it? How forthcoming are you about your kids and your kids driving in the other household? How forthcoming are you on any information? Is this an easy two-way dialogue, or are you being guarded and hiding something highly likely? And all of these things lead to, we're going to be good partners, and you're going to be openly disclosing and I'll be openly advising, or you play guarded so I play guarded. Like which lane do we want to go in here?
I think the other thing too is one of the things I've been looking for is Opta used to, now I'm not sure what they're called now. They sold the data. They've got data on clients in terms of profitability, ranking, that kind of stuff. But unfortunately, the cost is prohibitive. I heard it was $5 a hit. I'm not sure if somebody got it cheaper or not cheaper. But when that client comes in, it'll tell you, is it socioeconomically better, worse? And again, I'm not saying that's everything, but there's people that basically provide different levels of service, which I believe is still all right with the take all comers market, based on if the risk is good or not good according to the data, right? And that is how they're managing it. Versus before, you could pick which company you offered the price with. With the take all comers, you have to offer the cheapest and explain why you offered it with somebody else. If you have data, you would basically control how quickly you respond to that lead. If you don't want to write something, call them back in an hour. Now you won't get it. So there's people that are gaming their response times, I'm guessing, because that's about the only tool you have left, or trying to, I guess their marketing, they're going to try and figure something to do with their marketing to drive a different type of lead. I don't know how you do that in a digital world that easily, right? I ask every account executive, where's your best rates? I don't know. Here's some data from 8 months ago. 8-month data or 6-month data really isn't, it's better than nothing, but it's like, you're the company, you have all the underwriting information, you know where the fish are jumping, you tell me where I need to go catch fish, we got the bait and everything with our marketing and stuff, but you direct me where to go fishing. And again, they can't do that, so we have to magically figure it out with rates that are changing by the minute. So hopefully there's some tools that come out to help us, and maybe AI will help us price more profitably or something. But
So let me go back to Adam's 2 points earlier. Fraud was one, data integrity and accuracy was the other one, right? Because data scientists, actuaries, work on data. If that data is crap, you have a crap outcome, right? So it strikes me that from a carrier's perspective, that the integrity and the validity of the data is even more important, in 2024 than it was in 2014 or 2004. So turn that around to all three of you guys is, what can you do as brokers to ensure that the data that you're providing back to the carrier about your clients is factual and correct and complete?
You have to trust that what the consumer is telling you is fact. So I'll give you, we have a unique circumstance in that we write business under two different brands, which actually compete against each other. So but the teams talk to each other. So we see many circumstances, when I say many, at least a couple a month, where somebody has called one organization or the other and provided information, and they got a certain price. And what that was, and they declined to purchase, but what that was an education for the person in what to say and what not to say, how to answer things in order to get a price. And then they call a different shop, and now they know either what to disclose or not to disclose in order to manipulate their price. How is the second broker or whoever going to know that that person is not telling them the truth if they didn't have the luxury like we have of going, yeah, Tom called here yesterday, and he does have an underage driver living at his house, and
that sounds like a fraud indicator to me.
One of the things, obviously, you get driver's license and ownerships to make sure they match up. Like, that's some old school stuff, but getting a copy, and some people don't want to do the work on that. But if you look at their ownership and it's at one address and their license at another address, there's a lot of people postal code gaming. That's a big problem, right? Like, they realize that this territory in Toronto is really bad, so they come up with a number where their parents live in Clinton, Ontario, and they're paying insurance on that. There's a lot of that going on. Yes, stuff can be found out in a claim situation, but it avoids getting that in the books in the first place is way better, right?
Yeah, or it gets it on the books at the right price, right? Because when you're postal code gaming, you're paying, let's say, $1,500 for your insurance instead of the $2,500 you should have paid, right? So, and you paid that for 10 years, then you have a $10,000 claim, your loss ratio is still good.
You know what's valid too? I'd love to see benchmarking in territories and age grouping and things around how our book is measured on class usage. So what I don't think is relevant anymore is to say, Adam, here's your book compared to Jeff's. And if Jeff has a different strategy to only write in one town and I'm going off across a province or a country, those will look different. But if we can then talk about the ages or the cities and the percentile of class 01, class 02, winter tire discount, things that can be fudged around accuracy of data, I think you should have very serious discussion with your brokers around that. If you can equally come with accurate benchmarking. Don't just do this broad brush and say 25,000 clients are all the same. They ain't the same.
I think that data, I mean, we may not be able to come up with a perfect way to do it today, but that accuracy and validity of that data is really important today, and it's only going to get even more important, right? We talk about data all the time, and it's got to be right. And the source of it is your frontline staff.
Yeah, what I don't know is I don't have other benchmarking. So what I've gone to Intact to and said, hey, I would love to be accountable for my frequency of claims against all other books of business in this age banding. So please tell me very directly, and I will go manage my team, if, say, my average age in their book is 35, or they want to slice it into banding. Like, here's your frequency of claims in 25 to 35-year-olds. You know the ages, I know the ages, get it out of your system. and then show me against your macro book of 25 to 35-year-olds. And if I'm above that, I have a problem that I will go figure out how to do. But where I have a problem is when their average age of their book is 55 and my average age of my book is 35, and they say, Adam, do you know you're 2 points higher frequency? I said, no shit that a 25-year-old crashes more than a 55-year-old. Like, welcome to the meeting, Columbo. Like, what am I going to do with that? Like, you're getting more rate.
So that's an interesting one, because in theory, the actuaries back at Intact in this case they know what the frequency of a 25-year-old's accident rate is, and they price accordingly. And guess what? The 25-year-old pays more than the 55-year-old.
Correct.
That's how insurance is supposed to work.
Correct.
So at the end of the day, that should balance out into a equivalent loss ratio, because the 55-year-old crashes less, pays less. 25-year-old crashes more, pays more.
But everybody managing a brokerage listening to this gets one broker experience report that has one frequency across an entire book. Right? It's like taking your facility book that renews at 40% and your regular market book that renews at 80 and say, oh, your blended retention is 60. Like, well, what am I going to do with that number? Like, what is that good, bad? Like moving in the right direction? Like, it's such a bad data point that BD reps and these reports just regurgitate. And now I can't get the intelligence that has been designed by the actuary. And
they're the identical reports as they were 20 years ago. And I mean, in some cases, identical.
Right.
Therein lies the problem, because the tools and levers that you guys need to use and pull are different in a AI-driven, data-driven world than they were in a smell test. We like that guy's luck, we don't like that guy's luck world.
So here, I'll just throw something out here. What if contingent profit commission wasn't contingent, quote unquote, profit commission, or bonus, or whatever they want to call it? But as long as you're outperforming them, you've got bonuses. So frequency, severity, those sort of things. So Adam, your frequency is 12%. That's not good. But their frequency is 13. Well, you're outperforming their pricing strategy. You should get bonused on that, whether there's profit or not.
Yeah, I think that concept works. I think we need to refine it, because you then could not have anybody going to try and build new insurance relationships. Right? If you have 18-year-old kids and I build a message that resonates with them, and we start doing the heavy work, because it's a lot more work to deal with sort of young new insurance clients than it is a bunch of Toms. Tom's financially stable. Tom knows what he's doing. He doesn't miss payments. He doesn't make a lot of rapid changes up and down. So if I was financially incentivized to respond to low frequency, I'm going to try and chase a lot of Toms in that thing. And so, yes, to your point, but I need to slice in actual demographic benchmarking that goes up or down. Like, male or female should probably perform different too, I bet. Young age.
Of course they do. That's why they're priced different. So let's dig into this, because this is I think a really good avenue for us to go down. Is basically, what should CPC look like in the future? And this is, again, it's a relationship. It's got to benefit the carrier. It's got to benefit the broker. It's got to be fair to both sides. But it's got to be something that incents behaviors and that you can actually do. Right? There's lots of new regulations. Take all comers has a certain impact on what you guys are legally allowed to do. So in this new world with fairly strict regulations and a very high level of data-driven thinking that goes into pricing and underwriting, what kind of things can brokers do, and are those incentible in a future CPC or a future bonus program, whatever you want to call it?
I think everything's doable, and I think that's the call out, is that like the reports and those systems haven't necessarily evolved with all of the times. And so if we start listing out the things that the markets are likely wanting to incentivize that are in the control of the distribution they outsource, would be number one, distribution. So it'd be volume of sort of policy and product sold. There would be a difficulty around ability to cross-sell. So how many lines of product can you get me? Ability to upsell and sell deeper into that thing. Accuracy of data. This becomes a difficult one to do it, but if you were to beef up the audits looking for the accuracy of it, and it was based on compensation, not just binding authority switch on and off, there was gradients of accuracy for things that are actually relevant to the pricing and that. I think now you're getting into the chunky pieces. I think you're always going to have some profitability component to share in some of that windfall, or else you're not going to be aligned. It's like not having profit sharing in your sort of growing companies.
I heard a bunch of things there. I heard cross-sell, upsell, right? Those are great. I mean, upsell, usually if you're selling an umbrella, right, those usually have stellar loss ratios offsetting, maybe some problematic stuff on the lower end. Cross-sell, improve retention, that reduces everybody's expenses. Targeted, did you say targeted targeted marketing campaigns. I hear that you say that as well.
Well, I think if you list out all the things that are difficult, I think it's more difficult to cross-sell other policies than the financial reward that sort of fits it. And I don't think always the causation correlation. Like if I have a bunch of monoline auto and I hand them a bunch of tenants policies, so now they're 100% cross-sold, I don't believe their retention is going to move an inch, right? It's more the correlation that people who don't move around a lot and are really stable also happen to buy multiple products and be at that stage of their life. So I don't know if the retention one climbs in, but I think retention should be a variable on your variable comp, because if we're all churning through a bunch of the book and moving it over, well, that should add a point or take away a point depending on how you're looking at it.
For the right reasons.
It's just like that's cost. Then there's other reward and things, but like paying a broker that is doing nothing on the book into the maintenance and management and piece of it, when there's others that could be growing the thing or selling deeper or actively working it, is I think a bit of a missed opportunity. But I think we're starting to see that actually evolve now, as you're seeing there being bigger and bigger thresholds. Look at Aviva moved the threshold up and up and up. What is it? If you're not over 5 million now, you're not qualifying for much CPC.
Well, and then I had one executive say, listen, you can't really control anything with a black box. We're going to incentivize you for growth. We realize you can't do anything. So that was refreshing to hear that sentiment. They realized that, hey, we can't do anything. Haven't seen any agreement change with it, but they acknowledged it at this point, right? So it's there's not as many levers, and then things are shifting.
Maybe there's less levers, but certainly the levers are different, right? Like the upsell, cross-sell, it's always been a target, but if all of a sudden that is much more heavily compensated than loss ratio, maybe that drives some real changes at brokers. If there's things that you can do that reduce expenses from a carrier's perspective, that's real money to them. That should be incentivizable. There's probably a number of other things.
Well, let's look at is there a carrier out there at all that has some sort of target above or below that incentivizes the broker through added commissions for policy density? So policy density above 1.5 policies per customer gets you more money. I don't know of any. I don't know of any
either. However, I do know that some carriers, have done campaigns, throughout the year where there's a campaign to cross sell, and they will pay an override or, some sort of pre-agreed amount to do, for you to undertake that work. But if that's a provable regular thing, that somebody with a 1.7 policy density or PIF per client or whatever, has a better outcome than somebody with 1.4, why not? I guess what we're sort of searching around here for is what are some of those levers that are true partnership benefits that drive good outcomes for both sides, carriers and brokers, because loss ratio is becoming less and less of something that brokers can really have a direct impact on.
We have to also acknowledge we're going through a cycle right now in the industry where there's increased regulation. We've got weather patterns, like everything we talked about, threats, and we had another episode about it, reinsurance costs, interest rates. We're in the perfect storm of not one thing, but 7 things hitting everybody's results that we've never seen before, really in the history of insurance. And it's kind of made things more challenging on everybody right now. Like we're just in a really weird cycle. So maybe it's also tainting people a bit too, right?
Could be. Now, but when you say cycle or storm, you assume that there's an end to it.
Well, that's it. There may not be an end. Like this might continue on a lot longer than we think it is.
There's not going to be, like, once regulations go in, man, they don't come out. Right.
I'm not saying the regulation, but I'm saying, like I said, can we adapt? Like one of the things is the weather has changed. Can we learn to adapt and more resiliency? Right. Can we start attacking that and doing more educational things? That's one of the things that we have to try and do. Like the car thefts, it's really gone up a lot too, right? Like car thefts, loss ratios have gone up 4 or 5 points because of car theft. Yes, there's stuff going on, but we have a role as brokers to educate. I guess that's a lever we can do, is try and do a better job of getting tag systems in and trying to combat the car systems, right? So
yeah, I mean, like for my shops, my CPC will have gone down to a quarter of what it was or less 3 or 4 years ago, and it was all weather, all of it, 100% was weather.
And I hate to sound like a doomsayer, but I think we're in for more of that, right? Climate change is not slowing down. I mean, maybe a couple of years where you luck out and the forest fires in an unpopulated area, not beside a city.
So it's back to what can the broker do about it? Clearly, I'm not God, and I'm not going to be able to do anything about the weather, but I'm going to have to rely on my carriers to price appropriately so that profitability exists.
This is going down a different rabbit hole, but like to Jeff's quote 10 minutes ago about, you heard an executive say, okay, we're coming around to realizing that, like, if you're giving us accurate data and underwriting, we're in charge for pricing margin and how that's going to perform against our peers in the market. Here's a regulation thing. it doesn't feel like it's okay or fair to the consumer to say, sorry, Jeff, I got my pricing wrong for the last 5 years. I got to cancel that book and throw 3,000 clients out to the street. And I just need all those clients to go sign up to go back in the front door. Like, somewhere in the world of this fair treatment of customers and like a recognition of like how we got there, how you're missing that rate, like pieces like the broad brush swooping cancellation feels like, okay, that's kind of draconian in this like modern world of there's got to be a better way.
So I'd say two things. One is it should be renamed the fair treatment of new customers to make it more accurate. Secondly, I think the 4 words most brokers hate to hear most is, the BD guy from the carrier arrives and he says, I have a list. And like,
first of all, there's the treatment of all customers because it applies to renewals and if clients demand to be requoted or anything. So that does apply to everybody, not just new clients. And there's no more lists anymore because now the lists aren't, hey, move this to another company. The lists are, we don't want to renew it or we're reducing coverage. Like the lists have switched to move this to another company to we're reducing coverage on this to let you know the rates are going up this much for this class of business, which is complete, and if the rates go up this much, feel free to move it at this point. So there's no legislation if people want to jack their rates up to do anything, especially on property. Property's not regulated right now. And I hope it doesn't get regulated, but if we don't do a good enough job looking after things, it'll get regulated, right? Look at the US.
Part of the problem I have is like what feels appropriate is saying, dear customer, batch of customers, something, we need some new information. And because that's not allowed and people abused doing that, now what is allowed is saying, I can't ask you for new information, but I can smack you all out to the street. And that's my only recourse when I'm not happy with how something's performing. That feels silly.
An insurer, if let's go to this, what is the disincentive to that sort of action? If a broker wants to move a portfolio from company A to company B, and company B says, okay, in order to facilitate that, because we know it takes a lot of work, we're going to pay you an extra commission in order to help alleviate that, add to that, to help with the resources that will be consumed for moving that business. What about a penalty for an insurer who comes in and says, okay, company A comes in and says, we need to reduce the premium by 50%. So half your policies, find another home for them. Or in fact, maybe it's all of them. Maybe you get canceled and you need to move all of those customers, whether there's 100 of them or 1,000 of them. Why not contractually building in that cost? You want to get off all of these, I've got to find another home for them. Therefore, you're going to have to pay commission on all of them for the next year, even though they're gone, or whatever it is. You know what I mean? So
we all know the term override. I think you just invented the term underride.
Yeah, okay, underrides.
If I'm on the company side, I'm betting whether or not you're going to be relevant in the future. Because if I don't think you're going to be relevant in the future, I'm not going to pay that and I'm just going to break off the relationship. Because what I'm really doing is getting rid of these markers. I don't want to pay to get rid of them. They're just gone. I'm done with them. I'm done with you. Whatever. If you choose to service them and help them, go ahead. If you don't, then like they're going back to the market on their own.
So I guess the other question we have to ask is, it's almost been my entire career. CPC has always been, I wouldn't say God-given right, but it's always been in the industry. Is there a move like, New York tried to get rid of it through legislation? We get a lot of rules in Canada because of Switzer and all the stuff down in New York. What's going on? Like I said, the companies have to make money. They're not doing as well. Look at where the US is at right now, especially in coastal insurance in certain states. It's abysmal. Like you try to write insurance in Florida right now, it's brutal at this point. So, is there anything that can be done versus just getting through this cycle or not? Like, can people shift it? Because if you're growing, but the company's still not making money, yes, they should be charging adequate rate, but they haven't found that sweet spot between rate and keeping their existing book and writing new stuff. I'm just going to play devil's advocate. Is this a solvable problem?
So let me just respond to your sort of first thing about, should CPCs exist, and the whole Switzer thing and what have you. But my view on it is absolutely. I mean, absolutely, incentives are a fact of life in business, especially when you realize that every carrier is a free agent, every broker is a free agent, every client's a free agent, and as one of those people, one of those actors, you want to incent the other parties to do business with you more so than other people. So you incent certain behaviors. Sometimes you incent outcomes, sometimes you incent behavior, sometimes it's a mix of the two. But at the end of the day, this to me is a completely legitimate way to do business, as long as you're treating your client properly, right? That to me is the basic one. You've got to follow all the rules and regulations. You've got to treat your client correct. Recognize that they're a free agent, and if you piss them off, they'll just leave, right? But you got to treat your client fairly. Once you get past that, how you operate, how you incent others, that's That's a business strategy. It's completely legitimate.
And broker doesn't need to get it, but it's getting more and more difficult. Like the smaller broker, with the way losses have gone up, reserving practices, claims from 6 years ago popping out of nowhere, all that kind of stuff. It's more and more challenging for the smaller brokers because they don't have the volume to absorb the bigger loss, et cetera, to get it. And the thresholds are going higher, the stop loss are going higher. So again, this CPC is one of the factors pushing smaller brokers to sell. Like that's, because of the fear, right? Like that's accelerating consolidation. It's one of the factors consolidating consolidation, right? So that's what the companies are looking for. Great, but they're incentivizing brokers to sell right now based on how things are shifting, right? Or motivating brokers to take massive action to get their brokerage to a size that's relevant with each market. That's the other alternative you have right now to continue to play the CPC arms race, right?
The other thing you said that CPCs are one of the things that are incentivizing brokers to sell. One of the other things that is incentivizing brokers to sell is friction. So I have a theoretical question for Jeff and for Adam. Would you, if I came to you as an insurer and said, we're going to eliminate CPC, so no more CPC for you ever, but you also don't have to duplicate entry into a portal again, ever. You just send us the app and it's done. You don't have to do any of that. Your processing team for us disappears. Would you take that deal?
I'm going to say no, really, because the industry should be already getting rid of portals anyway. Like it's common sense. They should be moving that way. So CPC shouldn't be a lever connected to that. That's my opinion. But
The question is, so let's say you're getting 10, 12, whatever percent bump in revenue for your CPC. Is that outweighed by all the extra processing that you have to do, right?
the problem is, let's stop for a second here. The companies can't do it right now, so they're going to have to hire extra staff. You're going to have terrible service. So you might get, you might save money, but your service is going to go back to being terrible, right? So I just don't think I don't think we can go down that path at this point. Is how are they going to do it? They can't. They don't. You know how much they're going to have to hire resource-wise to do it, which is going to increase their expense ratio, which is going to make our price higher, make us less competitive. It's not good, right?
Adam, have you finished doing the math over there yet?
Yeah, I went very simple high math and said, if you averaged $500,000 on CPC on a bad year, like, do we have 10 bodies doing it? And we don't. Like, I don't think the numbers would work out as a fair trade.
The bottom line is the companies have to make money, and when they don't, what levers do they have to get back to profitability? They're not a charity, so
Let's talk about that. Like, what caused them to not make underwriting margin on a book or a set of risks? Like, it's got to be a pretty limited list of things. Maybe those are macro things, but the file was not properly underwritten with all the correct information. Okay. Nobody on this call desires to give partners bad info. Their actuary was wrong, and they got outmaneuvered by the marketplace. So in an our actuary versus their actuary battle, somebody priced it wrong. And you sold too much of it or whatever, you didn't get the margin.
Well, I look at one right now. Like we have one of our books where we have probably 10% to 20% of it turning. So some of it's coming on just because there's been so much drastic shift in rate. That's affecting loss ratio. We got we have theft going up, so we got to fight theft. You got cat losses coming in. You got all those things factoring in. And again, if you're turning that premium $1 million, you're not earning all that. So that's having a rapid effect on what your numbers are, right? And those are things somewhat out of our control, right? So it's challenging right now. Like I don't see any magic bullet here.
Not every company has this approach, right? I'm not going to name names here, but I do know one company that outright said to me that we don't view profitability as your issue, it's ours. Now they still have a CPC program, right?
I think that's a new evolving school of thought. I think that is what the emerging thinking on this.
And then a lot of companies too, they're doing their research. They're looking at every loss that is major, going back and would you write that? Was there anything wrong? And they're finding largely, no, we'd write that 10 times out of 10. Like I know some of our biggest losses is usually coming from clients who've been in the books for 10 years. It's not new people, right? It's stuff that you'd write 10 times out of 10. So back to the point, what would you do differently when you would write the risk anyway and something's happened? We're in the business to pay claims. Like,
okay, so let's try another thing precise. I've often contemplated, we had a cheeky line called lead bay. So like eBay with lead at the front, lead bay. And the idea that you could make a supermarket of your book of business that all of the insurance companies could go shopping down and pick and choose which clients they wanted. And let's assume for a second that, okay, well, we have the ideas for if it's right for the client, you can pick it, move it, and there's a cost for that. Now, if you imagine that thing existing and you having it, how the heck would any market decide which risk they like or don't like? What nutritional information are you going to put on the back, save for credit, that they're going to decide, like, if you could technically build this thing, could they actually action it? And the fact that they can't action it, I think, is part of this problem we're pointing to.
Well, it's difficult. We're trying to, like, you know what? We admire the problem right now. We're throwing out in the universe right now. There's a problem, throw it in the universe, the teacher will show up. So I think the biggest thing is we're talking about challenges that are happening right now. We're trying to think differently about it. And I don't think there's really an easy answer right now. There's not a definitive way, like getting rid of portals, going to APIs to fix it. There's no definitive way forward on this. So I think we're kind of at this crossroads. Now, again, I think there needs to be more conversation, but I think we had some great dialogue today, but I don't think there's any magic silver bullet that's going to solve it. And I think we get through this market cycle. And again, it'll be some kind of weird other cycle we've never seen before either. But we just have to continue to adapt and all talk together and work together as teams, right?
Is retention important to your brokerage? Of course it is. That's why at IFS, we have a cancellation prevention process. Want more details? Give us a call. I know you don't always use a premium finance company, but when you do, you should use IFS. Cheers.